A very good morning to everyone that's joining us on the webinar. It's great to have our Livewire members live and in a panel forum like this. I hope you're all healthy and safe, and yeah, really appreciate you taking the time to join us this morning. My name's James Marley. I'm a co-founder of Livewire Markets, and today's webinar is part of an income series that we've been running on Livewire over the past few weeks. Just going to run you through a few bits and pieces to get this webinar kicked off, and then we'll get into it with our two guests. Our guests today, I've got Pikoulas from Lipman Burgon Partners and Stephen Cabot from Credit Suisse, both highly experienced and credentialed wealth managers and wealth advisors, and hopefully they're going to help guide us through some of the nuances of investing for income today. We've got a good agenda lined up. Just to start off with a disclaimer there, please read that. This is not personal advice. Livewire does not issue advice, and you should definitely seek professional guidance and reach out to help before you make investment decisions. Today's agenda, very briefly, I'll just give you some context on the income series, and then I've asked each of our guests to share their hypothetical portfolio allocations using the asset classes that were covered in the income series. We put them up side by side. There are some differences, and I think it's going to be a really useful way to talk about how they're building a portfolio and the different ways that they use the asset classes that we've put together. We'll then get into a couple of common mistakes, tips to help your investing that hopefully will make a difference. And they've also shared a few underappreciated sources of income. So a couple of ideas for people to go and do some extra research on. At the end of it, we've set aside time for Q&A, and that really is your opportunity to ask some of your own questions. There's a Q&A tab, should be at the bottom of your screen. So if you've got a question, click that tab, type it through, and we'll address as many as we can get to. So just first of all, a quick bit of context on the income series. There is a full series tab, which I'll show you in a second on the Livewire website, where you can access all of the articles. To date, we've reached out to 8 different fund managers covering a range of asset classes, and they've shared their insights into those asset classes. You can see those listed on the slide in front of you. I'll just briefly bring up the Livewire website. If you want to go and find those articles, you just go up to the top right-hand corner here on the series tab, and you'll see there is a dedicated section for the income series. You click on that headline, and you'll see all of the articles that have been covered in the series, published by the fund managers, are listed there. It's also worth mentioning that we are going to be releasing an ebook in the next week, where all of those articles will be available in print format. So if you want to print it out and read it or hang on to it, you can do it there. And we'll also include an article with a summary of the key points from our discussion today. So that'll be a really great resource for people to use. I also want to just share a couple of insights from a survey that we ran before we started the series. We ran a survey with 700 investors about how they go about approaching income. A couple of quick stats before we get into the discussion on the portfolio allocation. So here's a few high-level numbers. 44% of people told us that they rely entirely on investment returns to deliver income. So a really big issue for nearly half of the people out there. 75% of people said they're willing to draw down on capital as well as harvest income, which I think is going to be a big theme in today's webinar. And 76% of people said that they can live with a small amount of volatility. So I think that's a good indicator as well. In terms of returns, 60% of people said they're looking for a return of between 5 and 7%, which to me sounds reasonable, but we'll ask our expert what they think about that number. And I think it's interesting, we saw that nearly 30% or more than 30% of people were willing to lock up money for a period of three years or more if it meant that they could achieve a higher return. And I think that's an interesting insight. That people's mindset, they understand they need to make a few sacrifices if they want to achieve a better return. I think that's a topic that will come up again today in the webinar. In terms of the lesser known asset classes, people are familiar with Aussie equities, global equities. Not so familiar with hybrids, bonds, corporate bonds, and private debt. They were the lesser understood asset classes, and I think we'll provide a bit of an intro into those things today. I think the key point to make there is everyone's different. You know, I know investing can be a bit of a lonely thing, and you know, use the questions to ask, use the question functionality to ask about your own specific needs, because not everyone's the same. We'll try and cover a few different angles today, but just bear in mind, if you've got some specific questions, please send it through. Rightio, so let's get into the portfolio allocations. You should be able to see on the screen now, we've got the different asset classes that were included in the income series, and Alex on the left-hand side and Stephen on the right have shared with us how they would put together a portfolio using the asset classes we covered in the income series. I think importantly, let's look at the differences. Alex, I'm going to start with you. It jumped off the page to me, a zero allocation to bonds. They seem to be a staple of multi-asset portfolios, but they don't get a run in yours. Talk me through the selection here.
Yeah, James, so in the past, they would have been a staple in our portfolios as well. But we think interest rates now have fallen enough that you have to reconsider that. And we've reasonably recently moved to a position where we're removing bonds, government bonds from our portfolios entirely. From our perspective, you need to think about safe haven characteristics of an investment like government bonds. And to us, if you're going to invest in a safe haven asset, there are two things to think about. The first one is the effective protection that safe haven asset is giving your portfolio. So does it have a negative correlation to other parts of your portfolio? And then the second one is, what's the cost of holding that safe haven asset, the opportunity cost, if you like. And so in this instance, government bonds, we think the effective protection that government bonds provide to portfolios is diminished now. We think it's unlikely that you're going to see the US and Australia move into negative interest rate policy environment. You know, the 10-year bond yields in Australia right now are 0.88%. That's less than inflation's probably going to be. And in the US, they're 0.58%, again, less than inflation is going to be. And so if we don't go into a negative interest rate policy, there's no room for capital appreciation either out of bonds. So that means that the protection that's providing a portfolio, we think now is diminished. And then the second one on the cost of holding it, well, you know, back to the point about that, what they're yielding now, less than 1% and less than inflation, the opportunity cost of holding that asset class now we think is too great. So we've decided to move out of it.
So the question is then, if the allocation used to be to bonds and it no longer is, where's that money gone?
Yeah, and look, it's a great question, because you don't want to then mean that means you're just risking out portfolios. And so what we haven't done is move that government bond allocation out of bonds and all into equities, for example. And so you can see on the table there, we've moved a reasonable portion of that into private debt. And we've also moved a portion of that into alternatives. Now, I'm happy to admit in the private debt segment, you are taking on some extra risk. There are some other factors as well that we think you're getting paid for, which is attractive. But in the alternative space, we've made an allocation towards gold there. And the reason for that is trying to get an asset that has some negative correlation to other risk assets in the portfolio to replace some of that negative correlation that your government bonds used to provide.
Okay. Well, I think we're going to talk about private debt a little bit further on. And I also want to have a question on precious metals, because gold's very topical at the moment. But Stephen, I might bring you in here. On the other side, you've got a 20% allocation to government bonds and a 22.5% allocation to corporate bonds. Could you share, you know, the thinking behind those allocations, and maybe give us a bit more colour around what sits underneath those two headlines?
Absolutely, thank you, James. So with the bonds, and I guess if we quickly take a step back, and this portfolio is designed to deliver a return of just over 5% in a, you know, with a volatility that's it's around 8.5 sort of vol, which is reasonably defensive. And so that's a key cornerstone of what we're trying to do. And if we can use a bit of a sporting analogy, you know, it's great when all the attacks working and everything's moving forward, but it's often the defence that can win your games. And you know, we're still placing a lot of importance on the defensive characteristics of the government, and to a lesser extent, but still important, the corporate bonds. Government bonds, totally agree with what Alex is saying in terms of, you know, where to from here and what do they offer. The philosophy around bonds is you generate some income, and it is the stabiliser to the portfolio. Obviously, the income is far less than what it has been historically, but the stabilising impact, we still think it plays an important part. We have looked at our offshore colleagues in Switzerland, where they've had negative cash rates since 2011, and negative bond yields, 10-year bond yields since 2015. And even in that period of negative bond rates and cash rates, when the equity market has fallen, you know, a reasonable amount, sort of, you know, 7, 8, 9, 10+%, the bonds have always delivered a positive return, or sorry, not always, most of the time have delivered a positive return. And over those periods, they've continued to eke out these, you know, modest but still positive overall returns. So there can still be an argument to hold them. It also then allows us to take a bit more, you know, aggressive stance on some of our risk assets. So, you know, combining them together in the classic portfolio way. Corporate bonds is something we as a house are more constructive on. In terms of our house, we were actually underweight government bonds. So in a portfolio, if we're starting with this as a strategic asset allocation, we'd be underweight. So we'd have a, you know, less percentage allocation than what's on this screen, but that would be the you know, the target over time. And we're a little bit more overweight the corporate investment grade bonds that sit in that corporate bond area. We've also included in our portfolios some high yield bonds, and also some emerging market debt bonds. So they're all sitting in that corporate bond area, and this is an area, you know, probably will come up a little bit later, as well as areas that we should be looking at to generate some income that maybe not everyone is that familiar with. Our philosophy is that we want to make sure that the defensive part, the bond part of the portfolio, is in our local currency, so Aussie dollars. So we're looking to hedge that exposure to any high yield bonds and emerging market debt bonds that are offshore, and even the investment grade bonds. The Aussie investment grade market isn't as big as the opportunities we see globally, and the banks can tend to dominate it here locally. So we're looking globally for those ideas as well, but making sure we hedge it back to Aussie dollars.
Okay, let's jump down a line. Alternatives. It's a headline that has a lot of different things that fall in underneath it. Alex, you've gone 15% alternatives. Stephen, 7.5%. Alex has mentioned a bit of gold in there. Stephen, what does alternatives mean for you? And can you shed some light on our viewers for the sorts of things that you like in that category?
Yeah, sure. So alternatives for us actually capture a bit of we would normally include private debt in the alternatives area as well. And primarily the reason for that is the less liquid solutions we tend to put in the alternatives bucket. The bonds component we tend to think of as being very liquid and accessible. So, you know, private debt would fit under that banner. We also have some gold commodity exposure and some hedge funds in that allocation. We also look at real estate. And at the moment, you know, we're looking at offshore real estate and using that to generate some yield as well. So it captures a number of little of the subheadings we have there. But importantly, going back to what Alex was mentioning before, is we're looking for asset classes that march to a different beat. You know, they're doing different things at different times. Ideally, all heading up to the right on a chart, but you know, sometimes we have to acknowledge that there'll be things in the portfolio that won't perform as well. And in fact, gold is an example of something that, you know, we're probably happy if we're not making too much money on that, because hopefully we're making a lot more money elsewhere in the portfolio.
Okay, great. Well, so we've got a few questions coming through on the next line, which is hybrids. Alex, you've got a 10% allocation to hybrids. Stephen, you haven't included hybrids in the portfolio, so I think we can talk about the whys and the why nots there. A question from Anthony. Alex, what do you think the major banks' appetite will be for hybrid funds going forward? Are you able to give us a view on that?
Oh, sure. Look, I think hybrids are an important part of the major banks diversifying their capital base and having an instrument that counts towards tier one equity that is outside of ordinary equity. So I think it's going to continue to be an important part of funding for the banks, and so you'll continue to see issuance and the ability to invest in that space. And
Okay.
I mean, it's seen in Australia, but also across the world, actually by regulators as a very important part of funding for banks as well. So when the banking system comes under stress, it's hard for them to raise equity, and particularly, they don't want to raise equity at big discounts when they're under stress. And so the bail-in, if you like, characteristic of hybrids and CoCos, which I think Stephen's probably going to talk a little bit more about later, is a characteristic that regulators like for the banks to have.
Okay. Now, another question was around the fact that hybrids could offer you exposure to things like Commonwealth Bank or whatever it might be, but without the volatility, although they were very volatile in the recent drawdown. Maybe address that point of what's the point in holding the hybrid versus the underlying stock, and talk us through your case for having a 10% allocation.
Yeah, sure. So, I mean, when I look at the allocations, it's interesting. I guess I sort of think about the hybrids a little bit like a corporate bond allocation. There's slightly higher volatility to the hybrids than there is in investment grade corporate bonds, without question, but there's also a high return to compensate you for that. So I sort of, between my asset allocation there and Stephen's, from that corporate bond and hybrid perspective, if you put the two together, they're similar. The reason I've put some of that allocation there from a credit perspective into hybrids is you're getting paid that little bit more than you get out of investment grade. And yes, you are wearing the volatility, but we think that volatility in the hybrids is a short-term phenomenon. We think it's very unlikely that you're ultimately going to see those hybrids converting into bank equity, and you ending up with less than 100 cents in the dollar from your hybrid investment. We think that is an unlikely or highly unlikely scenario. And because of that, we think the extra coupon that you're getting paid there over and above investment grade debt is worthwhile taking on. Okay,
great. Stephen, they didn't make your starting lineup. What sort of hybrids haven't been attending training? What's the
That's right. They skip training. No, they and I've illustrated a bit of a point here, I guess, by allocating zero to it. Is they agree with Alex that they generate a nice return. Excuse me. But importantly, in the capital structure, they do sit in a place between bonds and equities, and so you're giving up a little bit of some of the characteristics of both when you hold them. If we were to hold hybrids in the portfolio, what we tend to do is go, okay, well, let's take some of that allocation, and we're more likely to take it from the equity allocation and treat it as a sort of a high yielding equity with not much volatility. And the thinking being that in a crisis period, hybrids do tend to have that increased volatility and are more equity-like. So in a bad situation, they can exhibit that equity-type volatility. So we just want to be careful how we trade that off. We'd probably trade it off, partially against a bond allocation, pull a little bit out of the bonds, but more out of the equities if we were to put something into that hybrid bucket.
Okay, great. Next line down, as we move towards equity, we'll stop with REITs and unlisted real estate. It's been a really topical area because obviously what's happened with COVID, there's been the changed working arrangements, many of us working remotely. There was a big sell-off. They both still warrant an inclusion. That suggests, with both your portfolios, suggests to me that, oils ain't oils. There's differences within the, within that broader property sector. Stephen, what's your view on REITs and the unlisted real estate space?
Yeah, well, it's been a very polarised market. You've had the classic retail bricks and mortar that have, suffered enormously. Office a little bit of suffering, but then if you've been in the industrial or commercial area and anything that's related to the e-commerce, there's a big tailwind there behind that. So it does require some real thinking about where to allocate in those particular areas. It does have, it's similar volatility to equities ultimately, but if you can get something that's generating a good yield in the listed market anyway, that is, sorry, a strong yield, then that's absolutely worth thinking about. That's where we've been working with our clients and accessing some of the offshore REITs, and particularly those that are more focused on industrial and maybe multifamily sort of focused, and generating a good yield there as well. So getting the offshore diversification as well. So a definite place in the portfolio.
What do you classify as a good yield?
I guess it's probably dependent on each asset class, if we were to answer that.
Referring to that REITs line.
Yeah, so the REITs line, if we can generate a yield of, I think at the moment, if we're getting something around the 4-5% mark and above, that's what we're looking at. You do have to consider as well, some of them are more focused on capital growth than, or reinvesting their money, even some of them, rather than distributing it all out. And then it comes down to a question of how clients are thinking about it. Are they willing to, are they living on the income only, or are they willing to let some growth go into the stock and then, be willing to harvest that from time to time to supplement the income required? Mm-hmm.
Alex, do you have anything to add on the REITs in the unlisted real estate space? I mean, do you have a preference for liquid versus unlisted investments in property? How is that split up in your allocation there?
Look, we're investing in both listed and unlisted real estate, and the allocation is about 50-50. What I would add, what Stephen said, I concur really with everything that Stephen said. What I would add is our view on real assets as a whole. So, you could include infrastructure in that, is we're reasonably positive on the outlook on a medium-term basis for real assets, and it's for a similar reason that underscores our constructive view towards equities at this point, and towards gold, and that is that we think real interest rates are going to stay negative for some time. Not nominal interest rates, but real interest rates are going to stay negative for some time. In the US, real interest rates today are negative 0.9%. So that means that the nominal rate is less than inflation by 0.9%. And we think that's going to stay the case for, quite possibly at least 5 years, and it may go more deeply negative. Real interest rates in the late 70s were negative 5%. Real interest rates post-World War II were negative 15%. And why do we think this is going to be the case? Governments in the developed world are heavily indebted. They're getting more indebted through the stimulus programs related to the coronavirus at the moment. And the only way out of that situation is to inflate your way out of that situation. And central banks are incredibly focused on somehow getting some inflation back into the system. Now, they only want a couple of percent. I don't know if it's going to go beyond that number. But I think your base case can be they'll end up achieving a couple of percent with nominal rates at, still 0.5%, and therefore your negative real interest rate's 1.5%. That's an incredibly positive environment for any asset that gives you some inflation protection. That includes real assets, that includes equities, and includes gold. Okay.
Alex, while I've got you there, just a quick question from someone on the webinar. They want to know if revaluations and valuations down, I'm guessing they're assuming to in this market, how quickly do they flow through into REITs, and has that process already happened, or is that still to come?
It's a great question, and it's something to be enormously mindful of when you're investing in unlisted assets post a correction. I think you need to look at how those marks have moved and make an assessment on a fund by fund or asset by asset basis, whether it's been priced in. Across the managers that we use, we saw in real estate about a 10% markdown in the month of March on portfolios. The listed space moved more than that, but has bounced a little bit. To be honest, my gut feeling is the 10% markdown in unlisted assets could have a little bit further to go over the next few months is probably my gut feeling, but I think we're not far off the mark.
Okay, great. All right, let's move on to equities. We've put together domestic and global into one bucket here. Stephen, do you want to talk me through a bit of a view on equities? And is that, I'm assuming that you're looking at harvesting some capital growth rather than just dividends on that front?
Yeah, exactly. And we start with a traditional 50-50 split between domestic and international. And certainly the Australian market is renowned for its reasonably high dividend yield in an international context. So, you will get more income from the Aussie side, but more growth from the global. And part of that is tax driven, and the way that in Australia we get the franking credits. Certain jurisdictions offshore don't pay, or it's lower capital gains tax, so they're more incentivized to grow the stocks effectively. So that's where we've got to be happy, I guess, harvesting some of that growth. In terms of our view on equities, we recently moved to a neutral. We were overweight from March through to the end of June on equities, and given that strong run that we've seen in global markets, we took that as an opportunity to pare back some of the exposure. Just some of the signals out there were sending some signs that gave us a reason to have a bit more caution. We're generally positive on the markets, though. We think they are likely to continue to grind higher, certainly while there is this continuing fiscal and monetary support that's going on globally. So, we've got governments around the world, and a lot of that was and does have a sunset date. In Australia, we had the JobKeeper and JobSeeker, which was extended recently. In the States at the moment, they're going through the throes of working out what to do with the next round of stimulus for the consumer, and it's going on around the world. But there is this commitment from the central banks and governments that they're willing to really make sure that we don't fall off this abyss or into this cliff of trouble that this COVID crisis has caused. So while that's there, that is a big level of support. It doesn't mean equities can't fall, but it certainly adds a bit of a tailwind. And
40% in the table that our viewers can see right now, can that number go higher, or does it come lower? What's the range on that equity allocation for you?
Yeah, it's probably, we probably could, in an extreme view, go 10% either way. It'd be the way that we're thinking. If we're doing more than that, we've probably got the wrong sort of overall risk profile for the client. Either they should be more aggressive or more defensive overall. If we're really fluctuating that equity allocation number around, it really does throw them into a different risk bucket. So, a lot of the work that we do with our clients is making sure we get that risk bucket right up front, so then that we do take those tactical tilts around that strategic allocation of 40%.
Okay, great. Alex, on equities, can you, similar to Stephen, give us a bit of a view on what your valuation lens is telling you about domestic and global equities at the moment, and talk about how you would, tilt or tweak that allocation?
Yeah, so we're similar to Stephen. We tend to run about 50-50 mix between domestic and international. I think if you looked at it purely on an earnings outlook and opportunity perspective, you'd lean towards those international markets. But what brings you back to that 50-50 mix is exactly as Stephen said, franking credits are powerful. Don Hampson wrote in his Equity for Income piece as part of this series that he estimates that the franking credits add 1.4% to that annual return. That's a big number. Most people would assume somewhere probably between 7 and 8%. 8% is probably on the high end on a long-term return assumption for equities. An extra 1.4% out of 7 is a big number. So that brings you back to that 50-50 allocation on equities between domestic and international. From a valuation perspective here, comes back to what I said before about the outlook for real interest rates. I think headline price to earnings valuations on markets, whether it's domestically or internationally, look quite high at the moment. They have been higher in the past, but you need to go back to the tech boom to see that. But the difference this time is interest rates are at record lows, and when you take that into account, the equity risk premium, so the premium of the earnings yield out of equities over and above the government bond rate or the risk-free interest rate, is actually at wide levels, which means equities versus bonds are cheap. So at the moment we've got a neutral allocation to equities. We acknowledge there's a lot of risks out there. There's rising geopolitical risks. We're not, through the haze yet on the coronavirus. So there's plenty of risks, but with stimulus being pumped into the system by both governments and central banks, we think that'll probably continue to find its way into equity markets, and you don't want to be underweight at this point in time.
Okay, great. Listen, I've got 3 or 4 questions here, which I think really relate to this slide that we're talking to. So we might bomb through those quite quickly, and then we'll move on to the next part of the webinar. Just a question from John about quoting returns, and I don't mind who answers this question, but his question is, why quote absolute returns, e.g. 5%? Isn't it more accurate to quote returns above the inflation rate, e.g. I invest with a goal of 3% above inflation rate? So maybe if you could both just briefly touch on quoting returns and how you think about getting to the number.
Stephen, do you want to go?
Sure. So absolutely, real returns are absolutely vital in what we ultimately do. And the targets for many of our clients, and particularly those that might be sort of endowments or small groups or institutions, will often talk about an inflation plus target. And that is certainly the way that when we construct our portfolios, we've definitely got that in mind. So we think through a number of lenses, I'd say. One of them is in, the absolute number is relevant, and probably more relevant in the immediate term. And then we also have the longer term, which is, that's where the inflation plus is often coming through. So it's vital that we reflect on both those numbers and make sure we know what we're doing. In inflation at the moment, we saw the number yesterday, basically non-existent. What's happening is we think this COVID crisis is disinflationary in the immediate term, the more what we're seeing now, but in the medium to longer term, similar to what Alex was saying before, there is definitely likely to be some stronger inflation, and as long as that's kept in check, it doesn't get above the sort of 3-4% level, equities will perform well. That's an environment they do perform well, and if it gets above that, if it gets out of hand, then we have a few more problems. So I guess there's many lenses that we look through when we're constructing a portfolio. Absolute, real, and a lot of focus on the risk. What's the worst case, the drawdowns, and when we bring that all together, we end up with a portfolio similar to what we have on the screen there today.
Okay, just a good question on that point around inflation. Russell has sent through a question which I think is relevant to what you just said. With all the printing of money, inflation will possibly become a factor next year. I feel like we've heard that a few times. How does a genuine question, how does one protect against the effect of inflation? You've suggested equities. Is that the main go-to?
Equities work well in that moderate, up to mild to moderate sort of inflation level. As Alex mentioned, real assets are absolutely another great way that you can look to protect yourself, and you can actually look for assets that have inflation plus sort of revenue streams, and they're kind of ideal. Inflation-linked bonds is something else, and that gives you a very pure exposure to inflation. So they're something that we're building into our portfolios. And then gold and commodities in general are also tend to be fairly good diversifiers from inflation as well. So it also will come back to the fact that not any of them are perfect, but getting a diversification, a good spread of them, will certainly aid you in making sure that you're well positioned. Okay, great. Now, I was going to, as we get to the end of this particular part, I wanted to ask you both, if you were to try and squeeze a bit more out of this portfolio to up the return, what levers would you pull? And one question that's come through is, in the bond portfolio and other portfolios, would you accept any leverage? So perhaps you can address the question of leverage in your answers, but maybe give us a view as to how you might tweak the portfolio to be more aggressive if someone desired so much.
Look, I'll tackle that one first. Firstly, from the perspective of leverage, we don't use any leverage in our portfolios, and I think leverage can have many unintended consequences. Clearly, obviously, if markets go the wrong way on you, they leverage your return both ways. So that's not something that we do with client portfolios, and I think that adds a lot of risk to client portfolios, and we tend to shy away from managers that use any leverage, with the exception of the hedge fund space, where they pretty much always use leverage, but their portfolios are hedged, so they're trying to juice up returns that on an unlevered basis are fairly low. So there's a bit of a different dynamic going on there. In terms of how I would add return to this portfolio, and nothing's for free. So as you said in the introduction, James, you have to work out what you want to sacrifice. Clearly a very easy way to juice up the long-term return out of the portfolio here would be adding to the equity weight. And for our more growth-oriented portfolios, we've got an equity weight that's more in the mid-50s than the 35% that I've put here. But the other way that, the other investment that we've been looking at recently is distressed debt. It's not an investment that I've included on the allocation here. The main reason for that is distressed debt tends to have a very long-term lock-up period, so 7.5+ years. But if you look back to the GFC and the returns that distressed debt funds provided coming out of the GFC, you're talking about net returns in the mid to high teens. And that's an IRR over a sort of 5 to 7 year period. So they're very, very attractive returns, but you need to give up that, you need to be prepared to give up that liquidity and give it up for quite a long time if you're going to go down that path. So they're two things that I'd be looking towards. I guess the third one is within the private debt segment, which I have given quite a large allocation to. There's an enormous range of investments that you can make within that private debt segment. Some have lower risk, some have higher risk, some have longer lockup terms, some have shorter lockup terms. And so you can flex the return and the lockup period that and the risk that you're taking in that private debt segment to get some higher numbers if you chose to.
Okay, Stephen, the levers that you would pull if you were looking to get a bit of extra return?
Yeah, sure. And firstly, just on leverage as well. So leverage is something that Alex is absolutely right. It can just change the risk dynamics of the portfolio pretty significantly. However, Australians generally are reasonably comfortable with a level of debt, be it against their property or somewhere else. So if done in a considered manner, it can absolutely it can work. But there absolutely are the reasons we need to be very careful about making sure we get that at the right size. We've seen and heard stories about leverage destroying individuals with margin calls and so on. So you want to obviously make sure you're not in that predicament, through putting the portfolio together the right way and leveraging at a sensible level. The area that I'd talk about too is something that Alex has mentioned. It's looking at trying to harvest that illiquidity premium. So, private debt is one area, but also, private equity as well. I think in the original stats you mentioned, there was a portion of clients that were willing to lock up some of their money for a considerable period. And private debt, it's arguably a sort of 3 to maybe 5 year allocation. If for a portion of the portfolio they're willing to consider putting it into private equity, ultimately that should deliver better returns than public equity, if the theory holds out. And historically, there's been plenty of examples of that. But that can be up to a 10-year lockup. So you really want to be comfortable that you can invest over that time frame. And ideally, you're doing it with some different managers doing different things. So it does require apportioning, I guess, part of the wealth, being able to give up that premium. Otherwise, throughout the portfolio, we're just taking more risk in some different areas. In the corporate bonds area, you'd have a bit more of the higher yielding exposure. It'd be something else that could be looked at, and you just have to accept that there's a bit more risk in that, but you're doing it to eke out that better return.
Okay, great. Just before we move on, had a question around cash. Notably absent from this table. The reason is we didn't cover cash in the income series because it was basically I couldn't find a positive real return from even going 3 to 5 years on a term deposit. But there's another part to the question, which is how do you fund it? And these are hypothetical portfolios that we've asked the guys to put together. The role of cash, I think, for funding purchases and that sort of stuff. Stephen, what's the role of cash?
Yeah, the cash is, I mean, in any portfolio, there will be generally cash from time to time. It can be income that's come through to the account. It could be from sales, and it can be a tactical tilt you might take from time to time. If we were to go underweight equities, we might elect to just sit on some cash for a while. But that is akin to trying to time the market. So we want to be cautious about doing that, and not putting a lot of money in cash when we're thinking about portfolios. When people entrust us to run the money for them, it generally is to be invested. If we had a strong view that cash is a sensible place to sit, then we could be allocating something there. But generally, we run a pretty low cash allocation.
Alex?
Yeah, look, I mean, I concur with Stephen there. We tend to think about cash holdings as separate to the investment portfolio. So we have been advising clients for a couple of years to be holding reasonable levels of cash in terms of being able to fund their living expenses for 2 to 3 years outside of the investment portfolio, and not having to rely on drawing down from that investment portfolio for their living expenses. And that was because we were late cycle, and of course, nobody saw coronavirus coming, but we were late in the cycle, and I think a lot of people, not just us, thought that there was probably something coming at some point, and so we were recommending people hold a level of cash. But as I say, similar to Stephen, we think about that as separate to the investment portfolio mandate, if you like. I think the other thing about cash, I mean, so as you said, James, you can't generate a real return out of cash. So from a stable, ballast perspective in your portfolio, what is the lowest risk investment that you can get at this point in time that's not cash? We're looking towards some absolute return, low risk bond portfolios, but that don't carry duration. So I've said zero to government bonds here because to me that's a duration allocation. You can get some absolute return bond portfolios that don't carry any duration, so they won't decline in value if interest rates and inflation go up. And many of them look to achieve a cash plus sort of 2 to 3% return. So I think they are reasonable alternatives to holding physical cash, and they hold up pretty well when the market draws down. So the experience of the managers that we follow in that space was sort of flat to down by 0.5% in March. So they protected capital just as they were meant to, and they're achieving cash plus 3. That's a pretty good alternative to having cash earning you nothing. And then the last thing to think about cash is, holding some cash outside of being fully invested it gives you opportunity. So when you see an event like March, it gives you an opportunity to take advantage of markets that are on sale. Of course, that's always easier said than done. The amount of people that plowed into the market in late March is very few. But I think that opportunity value, the being able to take advantage of volatility that markets present you is quite valuable in holding some cash.
Okay. I'm going to move through these next few segments. We'll try and keep it quite quick and punchy for the next couple of slides so we can create some more time for Q&A. We've been knocking a few on the head as we go. Just a reminder, folks, if you've got some questions, type them into the Q&A box and we'll get to them at the end. Common mistakes. Alex, talk us through, you've got your list there. Talk us about some of the biggest mistakes you see people making.
Yeah, so look, for me, the absolute biggest one is looking at headline yield and feeling like that's where your protection level is on the return you're going to receive from that investment. And the easiest way, or the easiest example I can give you is the major banks or AMP at the moment have been yielding fantastic numbers for some time at a headline level, but certainly have not protected your capital, and so have ultimately proven recently to be pretty poor investments. And many retail investors across Australia are up to the eyeballs, particularly in the major banks. And I think they're looking at that headline yield and thinking that that's where my return is protected, and it's not. And you really need to think about total return and long-term outlook when you're investing, and that's the critical point. And for liquid investments like shares, you really should be agnostic, in my view, between receiving dividends or receiving capital growth. And a very quick example on that is, Amazon again versus, say, the major banks. Amazon doesn't pay a dividend, but they're reinvesting that money to grow their business. So the value of your shareholding after that is a lot higher. Or you can buy, a major bank share yielding 6%, but that's destroying value over time. With a liquid investment, you can easily sell a couple of shares to manufacture that income. It doesn't have to come through way of a dividend.
Okay. Stephen, some common themes there. You've talked about not wanting to focus too much on yield or dividends, which is similar to what Alex has said. You've also said focus on what you know, and interested to get a bit more into that, because what we've tried to do today is uncover a few areas that people don't know so well. So talk us through your focus on what you know.
Yeah, and I think that's most evident in clients who hold only Aussie equities, Australian equities or something, and that can be, maybe there's familiarity which drives that. It can also be access, which isn't always as easy to get access to some of these other areas that people don't necessarily know as much about. But we'll talk about, I think, shortly some of these other instruments and hybrids and similar COCOs, contingent capital securities, are areas that can offer a very good yield. High yield bonds, again, not very common here in Australia, so needing to sort of look a bit broader to try and find those investment opportunities. And so, focusing on what you know, it gives you a lot of comfort, but with the right advice, there should be some more opportunities out there. And the other thing just to mention is, by concentrating on the Aussie market, we can end up with a very heavy skew to the financials, and not only through the equities, but then if we take on hybrids as well, it's more bank exposure. And in fact, a lot of the Aussie debt is from the banks as well. So we've got a very big reliance on the Aussie banks. So we're looking for that, that any potential concentration risk that comes through as well.
Okay, very good. All right, a couple of quick tips, Stephen. I don't know if people want to read that first line there.
Yeah, I think I'm not telling anyone anything that they don't already know. I was looking at some numbers coming into this presentation today, and looking at what the 10-year bond yield in Aussie market has been delivering over different times, and it's 88 basis points today. In June 2008, it was 6.5%, and what we give to get 6.5% in basically a risk-free rate. The Aussie 10-year is as safe as we can get here in Australia. In October 1994, it was delivering 10.5%. Unfortunately, we need to recalibrate, and those returns, we all have different biases, and sometimes the anchoring bias of what we used to get becomes a really important factor. Basically, we're getting less than 1% on all that area now, so that's got to make us think about all the different areas. And so being then fixated on getting what return we had previously, it's just not what we're going to get today. And this is where it's good to think, as the question that came through from one of the listeners here was, think about in a real return perspective. Inflation at the moment is let's call it 2%. I mean, it was zero basically, but if it's 2%, back in the early 2000s, it was much higher. It was there was periods where it spiked up a lot higher, and back in the 80s, it was up around 12%. So the real return is something to think about too, and that way then we can think about the spread we're earning above that very low rate, that government bond yield, and if we can keep that in perspective, that will help a lot. And then making sure we're diversified. Diversified is the one of the most crucial components of building a portfolio.
Good stuff. All right, I asked both of you to share what you thought was an underappreciated source of income. Alex, private debt, you've talked about it a little bit earlier. Give us the quick elevator pitch on why you like private debt. And if I could ask you to address two questions that have come through from readers when you do this on private debt. What's the liquidity duration for private debt and alternatives in the portfolio that we had up before? And on leverage, you said you don't like to take leverage. There's a question from Evelyn saying, is private debt not leverage? So if you could address those two questions when you go through your the case for private debt for us.
Sure, thanks, James. So, look, we like private debt simply because we genuinely think there are outsized risk-adjusted returns that you can earn in the space. And the reason for that is a fewfold, but predominantly in Australia, what has happened is because of increased regulation coming down on the banks have pulled out from lending to a lot of segments of the market, and particularly segments that are a little bit more complex. And so there has been an opportunity that has opened up for private capital to fill that void. And there are some incredibly attractive returns being received there. And as I said before, you know, there's a myriad of ways you can get exposure to this with different levels of risk and different levels of return. But if I can give you one example, you know, we were involved in one transaction where we provided a developer with some debt. We lent him some money on a bunch of apartments that had completed construction. So there was no construction. We don't like taking development construction risk and land and all these sorts of things. These are completed apartments that you could rent out tomorrow. In fact, a bunch of them were already being rented. We were lending him 65% loan to value ratio and getting paid 11% to do that. Now that was a short-term loan. He just wanted that money until they were sold. And that was why he was willing to pay that extraordinary high amount of interest, but he didn't meet the bank criteria because there was loan to income issues and those sorts of things from his perspective. We were happy that the asset value was there. We did our checks on all of that, and we thought it was actually quite a low risk investment to extend him that debt. As I said, at a 65% loan to value ratio, getting paid 11%, to us, that was an incredibly attractive return. That got refinanced 12 months later, and we clipped that 11%. It was a great investment. We prefer to go through managers, just to be clear in this space, rather than going asset by asset, but that's just one example of the sort of returns you can achieve in this space through what we would say can be relatively low risk investments. You do have to be very, very careful in the sorts of underlying exposures you're getting here to the manager and what they're doing with that money, who they're lending money to, and the risks that are involved in those projects if they're lending money to developers and those sorts of things. So, you know, private debt is one of the reasons that I said, what can people do to make a difference? You need good advice. You know, the private debt segment has opened up in this country and it's growing a lot at the moment. We think there's a lot of opportunity there, but gee, there are some risks too, and you need to know what you're investing in. And that's why I think it's really prudent to make sure you're getting good advice, that you're very, very comfortable about the risk that you're taking in the segment, because it is opaque and you need to know what is underneath the surface. To answer the two questions, liquidity, a broad range of liquidity. So some is locked up for up to 3 years, but there are products in the market that have quarterly liquidity as well on the redemption, being able to get out quarterly. They tend to generate slightly lower returns, but you're still talking about in the 5-6% sort of range. We are invested in some products like that. Again, generating that 5 to 6% range in private debt, you're talking about some very low risk investment grade type levels of risk, but for a much higher than investment grade listed bond market return, which again is why we like the private debt space. And then lastly, on the leverage question, you're providing leverage here to someone else. So you're the debt provider. There's no leverage being taken within the fund, within the private debt fund to generate that return. So we like doing private debt only when it is secured against assets and it's in the senior, preferably first mortgage position. So if something goes wrong, you own the asset and you own that asset at a big discount to where the person who you've lent the money to bought that asset, and we get comfortable by the underlying valuation of that asset that there's a lot of protection there.
Okay, great. Thanks, Alex. Stephen, your slide. I asked if you could. These things are, I think, for a lot of people pretty new. So, where possible, give some specific examples of the sorts of things that people would be investing in these asset classes, if you could.
Yeah, sure. So, I guess in terms of an analogy, what we're doing by recommending some offshore credit is just opening up the playing field. Within Australia, we've got a wide range of options, but when we go offshore and look at extending credit to different countries, different industries, that just means there's a whole lot more to choose from, and there can be opportunities there that we can take advantage of we can't get here. Investment grade credit in the States is paying about, I think, 1.3% on a sort of 5-year duration, so that's interesting. If you look at the high yield space, so they're non-rated groups, and then you can get up to 5% on maybe more in some of those areas there. So it's just seeing these opportunities that we don't necessarily see here. We're often employing managers to help go and identify specialists in those areas who can seek out those pockets of value. Emerging market debt is exactly sort of what that explains, which is the debt issued by emerging markets, generally government sovereigns, but also some corporates there that are big enough that we're comfortable enough investing in. Again, you generate and expect a higher yield. There is risk in all these things, and we need to be very cautious of that. But by spreading it around and harvesting a little bit here and there, it all adds to the overall position. Subordinated debts and COCOs. So within a capital structure of a company, the most senior investment we can make is senior debt, similar to what Alex was talking about, that first mortgage piece. You can get then subordinated debt, which isn't quite as senior, and you might have a few caveats that the debt has been able to negotiate. Then you get into what is hybrids, what we call hybrids, which is they trade on the ASX here, and they've got some equity and some debt characteristics. They can defer the bond or the interest payment. They can defer that from time to time, which you can't do in debt instruments. And that's what COCOs are, these contingent capital securities, which offshore, generally financial institutions issue, and they sit further down that capital structure. And that ultimately means we can earn a better yield, and we're probably earning about 5% in US dollars on those COCOs. And there's occasionally pockets where you can get opportunities of earning more. Now they're not always easy to access, and so that's something to be mindful of. But there are some funds, local funds here that will invest in those securities. So if we're looking around, those options do exist to get and it's good to get broad exposure that the fund gives you. So that's certainly worth considering. And then I've also included the private debt there that Alex has talked about quite extensively.
James, I might just add just super quickly, because Stephen mentioned access, and it's really important. I would say up until very recently, private debt was very, very difficult to access for private investors. It's becoming a lot easier to access, and a lot easier to access some good products and some very well managed products, and managing the risk very effectively. So for wholesale investors, people who meet that wholesale requirement in the Australian market as an individual, there are some fantastic products that are out there now with reasonable liquidity that are taking fairly low, as I said, investment grade type risks, and getting some very good return for that level of risk. So access has become a lot easier in the private debt space, even just in the last 6 months. But I think ultimately it does come back to that there isn't any free lunch. What do you want to give up to get that return, or what do you want to sacrifice? We, as an organisation, are always looking for ways to get that extra return without pushing out the risk curve. So if you can give up something else rather than just taking on more risk, we think that's a great way to add return to a portfolio. So it might be through the liquidity premium, as Stephen mentioned earlier in today's discussion. It might be through complexity. And we think in private debt, it's simply supply demand, and the fact that it's still a reasonably unknown space. But you've got to think about what are you willing to sacrifice, and how would you like to try and achieve the return that you need.
Okay, a couple of quick questions to wrap up, because we're right on the hour mark. But just a definition, we've talked about wholesale investors, sophisticated investors. A lot of our readers fit those categories. We've also got some direct retail investors. Can you give me the quick 101 for people out there wanting to know, some of the products that you've talked about, the funds they won't be able to access? What are some of the things people need to know about classification of investors?
So in terms of a classification, you need a wholesale certificate from your accountant, typically, to meet that wholesale classification. I think it's $2.5 million of net worth or above, or an earnings of over $250,000, I think it is, per annum. Please check those numbers. But there is a specific requirements there. If you work in financial services, you can also get allowed in as a wholesale investor. So there are specific requirements that you need to meet. As I said, please check those numbers I stated, because I work on the investment side of our business, not as an advisor. Our advisors are all over those numbers.
Okay, but it was a good little segue into my next question, which comes from Robert, and it's about private debt, but it's about, he's called out MXT, which is one of the metrics funds. And his question is, it's a listed investment trust. Is that regarded as private debt? And I think it's an interesting point, because a lot of the asset classes that you've both talked about today that have generally been only available to the wholesale market have now been brought onto the ASX. There's 8 or 9 of them, from private debt, high yield bonds, hedge funds. Where do you guys classify those? And could you maybe give me I'll get both of you just to chime in on those listed investment trusts that we've seen come to market.
So Metrics. So Metrics are a private debt manager. So absolutely, that fund is a private debt fund. We tend to shy away from the listed investment company and listed investment trust market, and there's a very simple reason for that. When I'm taking on risks, and when our clients are taking on risks in investing in their portfolios, we want that risk to only be around the underlying assets and the value of those underlying assets in the portfolio, and we can make an assessment on that. The problem that we think the listed market faces is those trusts and companies listed on the market tend to then trade at a premium or discount to the underlying net asset value of the fund, and particularly when the market is in a stressed environment, they tend to trade at big discounts to the underlying net asset value. And that extra level of risk is something that we don't want to take on, because inevitably the time at which you want to redeem or sell that investment will be the time that it's trading at a big discount to the stated NAV. So we prefer to go straight into the funds where you can redeem at net asset value rather than having to sell on market at a big discount.
Stephen, anything to add there?
No, we actually adopt a very similar approach, and in terms of access, that does limit the access for some people due to the availability of different ways. The ASX does open up a new avenue for many, so it satisfies some goals in that respect. But that discount is something that caused quite a few issues back in the March-April period. And I think on the Livewire income series, you had an article about the listed investment trusts as well, and will they get back to their NAV? So it's something that's known and a challenge, but it can give you access to some of these otherwise hard to access classes of assets that we have discussed today. Great.
Well, gentlemen, we're going to wrap up our webinar there. To all the attendees that jumped on, I just want to say a big thank you for tuning in. I hope you got some value. I feel like our guests have really given a good look at how they're investing with those hypothetical portfolios. Their contact details are up on the slide in front of you if you'd like to reach out to them with follow-up questions. And keep an eye out for the Income Series ebook. That'll be coming out in the next few days, and we'll also include a wrap-up of this discussion. So thanks very much again, everyone, for tuning in. Stay safe, have a great day, and we'll see you on Livewire soon.